Alright guys, we're back with the business strategy game. So I wanted to give you guys a quick little update. I missed the year to show you the decisions that we made in year 14, but we're going to go back and we're going to take a look at it. So I wanted to show you guys kind of what we were doing with year 14 and where we were at the time before we get into what we're doing here in year 15. So year 14 was an interesting year for us. We're really trying to differentiate our strategy. So if you look back over the last couple of years, let's go ahead and start with like year 11, right? So that was a really, really bad year for us, and we made a big gamble in private label, and it didn't pay off, as you can clearly see. We actually got beaten out by both teams and ended up just not really selling a lot. So it wasn't a solid strategy for us. It actually ended up really, really hurting us playing that market, and it was kind of a losing battle every single year. Now this was an area that we really did well in the simulation game, in the practice game, and because of that, everyone saw the importance of the private label segment, and they kind of dove into it while solidifying their strategy. So we really had a lot of catch up to play. Now, getting into our year 13 decisions, what we really wanted to do was focus on differentiation. Now, as you can clearly see, where we were with our internet and wholesale, we tried to move away from Company B, and that was really important for us. Company C, they were solidifying their strategy. They're definitely going for a high quality shoe at a reasonable price strategy, and it's a really solid strategy. So we were trying to figure out how to get away from Company B in order to get the profits and to be able to get enough capital to start to move into a better strategy, and to start to move up and to the right of Company B, and also save from Company C. So we're really just trying to find our most profitable mark, our most profitable segment from that standpoint. But we're also setting ourselves up for some differentiation, and what we really did was we focused on figuring out how to lower our costs, like lower our production costs. That was a big deal for us. So we built a plant in Latin America. I don't know if you guys were watching back when we did that, but that was important for us, was to differentiate our costs, and then to lower our costs. And now we're trying to differentiate, or we're trying to change our strategy on a differentiation strategy, really focusing on profitability. So that was the conversation that we had the other day. As you can see where we're at right now, our quality rating is rising, our wholesale price is stable, our internet price is low and stable, and we have been, really kind of getting in here with the private label segment and just kind of taking that market, while also trying to grow our wholesale sales. Those are kind of our two main strategic objectives right now, and how we're doing that. Let me just get back to that screen. So how we're doing that: we want to keep our internet price low. We want to continue to get market share there. We're going to start to raise our internet price, but seeing how Company C is coming in and trying to and really trying to take some of our internet sales away by lowering their price, and I didn't like that. We're not prepared to necessarily lower our price in order to get more of that market share. We want to focus still on profitability, but we are going to be more aggressively going after this segment. We don't want to turn into a price war. But we feel like we can differentiate in other ways, and that's going to be our next major thing this round that I'm going to be looking at. Also, on our wholesale price, we figure we can be a price leader in Latin America, so we have a plant there, and we have better production and more production there than everyone else. We're spending a lot of money there, and we've taken over quite a bit of the market. So now we can start looking at different ways to really round out our demand, and really to start to get profitability out of this market, where we're talking about year 13 decisions, or year 14 decisions. But yeah, I mean, still, this was our plan. Our strategy in Latin America was to build out our plant, to build out our capacity, to grow retailer demand, and to gain more of that market share. We really want to be the price leader in Latin America, and we were doing that through an efficiency strategy by keeping our production costs low. If you look at Asia is a really hotly contested market. Everyone's priced right about the same. Everyone is jockeying for position in this SQ ratings category. Everyone's spending a lot on advertising. It's just really, it's really a drag race. And company C, they're pulling away because they're giving a much better deal. They're giving a lot more value for the cost. So people are noticing that. We don't want to lose this market, so we're going to have to start figuring out how to play in this market and really how to differentiate ourselves. If you look at the strategy map, we are moving away from company B, and we just have to figure out how to not let this thing get away from us in this market. Now we were playing really low in this market. I mean, we're actually below break even in the private label segment, and we were doing that in order to get more plant efficiency to be able to produce more shoes at a lower cost. So if we can continue to get those efficiencies, maybe we won't take as much of a loss in private label. We won't raise our price too much, but we can start to shift that efficiency by raising our price here into including the SQ rating and keep the same profitability in this market. Start to go after company C a little bit and see how they adjust with that. With Europe and Africa, nobody has a plant here, I don't think. I need to go see. Let's see, where would I find that? Plant capacity. Let's see. So company B just made they just increased their capacity, and company C just increased their capacity. So they're also trying to get more capacity. Company C, they're trying to get more capacity. So everyone's trying to get to the same place that we're in, where they're able to produce more shoes. That is going to make. I mean, we're essentially going to flood the market. So it's gonna start to get make it a serious price war. So we need to figure out how we're going to deal with that. That's really going to be annoying. And we sold some of our capacity. Did we sell our capacity? Yeah, we did. We sold our North American capacity. So we are. And so did Company B. Company B sold their North American capacity. Yeah. So yeah, that's going to be interesting. So we're going to be right there neck and neck with Company B. And we need to figure out how to further differentiate from them. I really can't stand them. They're really stealing my strategy from jump. They're watching everything we do, following like closely, and actually executing on it a little bit better than we are. It's so annoying. Because they're exactly in the spot that we wanted to be in. If you look at our celebrity endorsements, we have a number of celebrities. I think we have a large advantage in Latin America, which is really our focus, and so we're really going to need to stay on top of our celebrities. As you can see, the BSG company, they're really aggressive with celebrities, so we want to make sure that we keep a good mix of celebrity endorsements to keep our branded sales up and move from there. So we have some decisions to make this year, but our real decisions last year. Let me just show you guys what we really did. The real big issue in year 13, which is what we're looking at with the private label segment, and what we decided to do, we kind of decided to bet the farm in Latin America. So we kept all the other markets right around break even. We kind of just hovered right around that break even point in all the other markets, just trying to make sure that we were able to keep our efficiencies. But in Latin America, we actually increased our price to $34.99, which is right underneath these guys. We figured that after going to $13.99 in Latin America, just showing that we were willing to flex our muscle and just go for broke, that we would scare both the other competitors out of this market. They just wouldn't want to compete in it. So we were able to come in at $34.99. That was our huge gamble in year 14. So yeah, it was a huge nail biter. We didn't really know what we were going to do or how we were going to do, and that was what we did. Now I'm recording this after the fact, so I know how it played out, but I'm trying to record this just in a way to archive our decision and make sure that we're doing the best we can, just keeping everyone informed about what we were thinking when we made these decisions. So that's my analysis. That's what we were working on in year 14, and stay tuned for year 15. We're going to have our meeting tomorrow night.